A few weeks back in time, I was sitting at breakfast with my wife and my two kids, and my older daughter is now 2.5 years old. And she really likes to talk to Siri. And so she asked Siri what the weather will look like at that day. And Siri answered back, "Where?" And my older daughter was not very amused about that answer, not getting a straight answer like sunny 20 degrees. And so she simply said, you stupid little thing. Okay. So why do I tell you this story? First thing, the Siri request couldn't be answered straight because I was simply cutting off very important data to Siri, which is I set off the location service of my smartphone. So Siri had to ask me back where I am. And that leads me to the second point. As long as we human beings don't give the right data to the machine will never come up with the right answer. And that's very important to know. Also, when we're now talking about crisis. Before I start with the 200% AI funds today, I would like to give you some personal views from myself about AI and crisis. So I'm a mathematician and I'm looking at this, let's say, task, predicting a crisis, let's say a drop of 30% or more in the equity markets. Well, first of all, from a data perspective. So the data perspective is that in hindsight, for sure, you always need a different data set to actually predict a crisis like a drop of 30%. So just looking at the last three, let's say, major crises, like the dot-com bubble, where valuations were a bit too high, then the global financial crisis, credit, and now the COVID-19 crisis. Dr. Leber already mentioned it. You could have looked at temperature data, alternative data, but you always need to know it before. Afterwards, it's pretty easy to explain why something has happened. And so that leads me to the second data point. Probably the next crisis needs a very different data set than the ones that we had before. That's the thing about the data sets. And the second thing is a more technical reason. Dr. Leber came up with that example that a child touching a hot surface knows that it shouldn't touch it again. So it learns by very few shots. And that's also where a lot of research is currently done in the machine learning field, the so-called few-shot learning, which means that the machine learning model gets by as few training examples as needed to generalize in a task. And as we know that these drops of more than 30% in the markets are not every day, we know that it's very rare, and we really just have a few training examples. Therefore, for me, the conclusion is predicting something like a 30% drop is like the icing on the cake if everything else works fine. And so what we focus on, first of all, is stock selection. We're equity investors, and portfolio construction, two tasks. And I haven't asked the machine or our machines to predict this crisis. So I can't blame it that it hasn't predicted it. So because it had different tasks. But for sure, before that crisis, before the conference, sorry, Dr. Leber asked me, if you would know that the markets will crash 30% in the coming month, would you do anything differently? And I said to him, sorry, no, because of the points I mentioned before. But also, again, a very important thing is the timing. So if I would have to predict a crisis in the future, I know I need to be very accurate. Very accurate. Why? Because in between, the markets can double, triple, whatever, and you miss that if you are going out of the market too early. So a very different task, and Now, I want to go to the actual agenda, so talking about our two AI funds that we have. That's the ACATIS AI Global Equities, so it's investing in global equities, and the ACATIS AI Bus US Equities, which is just investing in US equities. For both funds, I have kind of like the same agenda. I want to give you a brief introduction to the fund, and then it's really just a 3-minute pitch, so to say. And then I would like to explicitly talk about what our thesis have been for crisis in this strategies when we launched the funds. Because for sure, we thought about when the markets crash, what is going to happen in the fund. And then I would like to show you, with you, if we can validate these theses using the current COVID-19 crisis. So let's start with the global equities. What we would like to do here is, as a data source, we use only fundamental data. And we would like to analyze this fundamental data with deep learning techniques. And we don't do it only by ourselves. We do it in a partnership with a Switzerland-based company called NextGen. There's a team around Professor Jürgen Schmidhuber, who is one of the pioneers in the field of machine learning since the 1990s. And it's kind of like working together. We bring in the data, then idea generation together. What should the machine look like? Then the implementation is done on the NextGen side, and the implementation of the real portfolio in the fund is then done again on our side. So just a quick pitch. So how does this AI portfolio manager look like? On the left-hand side, you see the data pillar, which is just annual and quarterly report data of stocks worldwide. Then we use this data to give it to the machine, to machine learning models. And the stock selection objective is to find the outperformers for the next 6 months. Then we have a portfolio construction on top of it. And in the end, you can say how many stocks you want to have in the fund. In our case, it's 50 stocks, long only. And we just rebalance every 6 months, which you should keep in mind for the rest of the presentation, because it's very important what has happened in the crisis. So 3 theses in this fund for crisis. First of all, what we have seen in our tests, drawdown like the market, but faster recovery. So in theory, what we do is when we develop a model, we do a so-called walk-forward test, which gives us results for the past, and so that we can kind of like evaluate what the machine would have done in the past. And what you see here in the chart is a drawdown chart of our AI strategy in blue, and in red the MSCI World is our benchmark, and how it has done in the financial crisis in 2007 to 2008. And as you see, the machine is always 100% invested. So, and when markets go down, we all know that the correlations go up in equities. And it's really hard to escape from that if you don't have a cash decision or anything else, like derivatives or whatever. So 100% invested, but what happens after we bottomed the crisis? Well, the machine gets the new fundamental data, and again, it focuses very unemotional on its task. That is, to find the outperforming stocks for the coming period. And what you see in this chart is that the market recovered 1 year later to new all-time highs than the strategy. So that's theory. Now put it into reality. What has happened in the COVID-19 crisis? Year to date, the fund went down 3% more than the market. So not really what we have tested, but it recovered the 3% till Monday. And it's now in front of the MSCI World, so it outperformed in the recovery. And yeah, we simply have to see when the new all-time highs will be reached by both. So we can't really validate it, but we can also not neglect it. So Second thesis for sure comes from my heart. We are a value company, so for sure I say that fundamental investing should always help you. And that's for sure always okay, because in theory, if you look at the Farmer and French high minus low strategies, you see that over long-term horizons, fundamental long-term investing is the superior investment strategy, even though we see in the last 10 years a clear drawdown, a clear downtrend of this. And for sure, the last 10 years were really more like a growth period. But still, over long-term horizons, it's valid. What you see in this chart is the outperformance of value over 20-year horizons rolling. And yeah, now, again, taking this theory, most people ask me, then, how do you actually know that your strategy is a value investor? And that's for sure a very valid question. So what I usually do is, after we did a rebalancing here in January, I look at the averages of factors in the portfolio and in the benchmark to at least get kind of a feeling what the investment strategy of the AI is looking like. So what you see here is a spider chart of 10 different factors. And in blue, these are the averages of the portfolio, and in red of the MSCI World, the averages. And you read it like that. So let's take the PE ratio in the middle far right. The portfolio average was kind of like 20 in January, and of the benchmark 22.5. So and you can see that not only in the PE ratio, but also in price to book, return on capital. So it's more like value or fundamental oriented. So we can maybe slightly say, okay, that's more like a fundamental strategy than the benchmark. A more compressed representation you see on the right-hand side, a style analysis really just on, is it value growth, is it small cap, large cap? And what you see in this chart, the blue is the percentage of the fund invested in a specific style, and what you see is nearly 70% of the fund is invested in small cap value. And also what you see is on the left-hand side, our current top 10 stocks. It's very refreshing also for a lot of people to see this, because there are not the usual suspects in the top 10 like Amazon, Google, Facebook, and all the big fund names. And also fishing in this small cap value bucket is always very interesting, because this is one stock example, one company example that we had in the portfolio, Portola Pharmaceuticals, which was acquired last month in May by Alexion. And the AI really finds that a couple of times. So it's not the first acquisition that the AI has found. And so that's really what we would like to find. Good companies maybe getting acquired or outperforming the market by some other mean. And so to kind of like sum it up, what you see here, it's a big chart, I know, with a lot of information. But if you have seen our presentation of my colleague, Dr. Eric Endres, and mine at the last conference, then you maybe still know that we were talking about major changes after a couple of time in the AI fund. And we did some major changes in 2019 in the summer. And what you see here is the time since that rebalancing, how the fund has done. And what you see in blue is our AI Global Equities strategy. And it slightly outperformed in red the benchmark, the MSCI World Index. For sure, as mentioned before, in the drawdown, it went more down like the market, but it recovered a bit faster. And looking at our, let's say, style benchmarks, MSCI World Value and Small Cap, we clearly outperformed them. On the lower chart, you just see the outperformance per rebalancing. So every 6 months we rebalance, and kind of like we start at 0 because we have a new portfolio. So, and the third thesis for a crisis is very obvious and very simple. So the AI should act very unemotional. So the question, what has the AI done during the COVID-19 crisis? Well, nothing, because our investment process is that we just retrain the machine and rebalance the fund every half year. So the next rebalancing will take place in July. And then we take the fundamental numbers that came out just recently, and the machine should look at them and see what the new trends are and how it should adjust its strategy to find again the new companies that should outperform the market, in the next 6 months. So now let's go to the AI Buzz US equities. Again, we don't do it by ourselves. It's done with Periscope Capital. What we want to do here is, Dr. Leber already mentioned it, we try to take sources, online sources, text data, and try to analyze them if they are bullish, neutral, or bearish. Then we aggregate these sentiment scores and invest in the highest sentiment stocks, so to say. So that's the AI portfolio manager. In this case, on the left-hand side, text data from online sources, only US companies, so only text in English is analyzed. Then we have, again, the middle part, the natural language processing models. And in the end, we have 75 stocks in the fund, the most bullish. Long only, always 100% invested again, so no cash decision. And again, there was no task to the machine to predict any crisis or whatever. So it's really just focusing on a very narrow objective if a text is positive, negative, or neutral. So 3 theses, in this case, it's a bit harder to test or have a theory about it because we don't have enough data before 2013 to actually have a strategy live. So there's no testing before that. So I can't show you any drawdowns in the financial crisis or in the .com bubble or whenever. So for me, my worst case scenario would be that that it has a drawdown like a momentum strategy. And again, to see it farm on French, we all know that a long-only momentum strategy crashes much more in a crisis than the markets. In reality, the fund went down as much as the S&P 500 as the benchmark, but as you see, it recovered much faster, and on Monday it had a new all-time high in the fund. So the last couple of days probably not anymore, but at least we see that it found the right topics, so to say. So, and what were the rebalancing themes, positive and negative? So in March, when we had really the bottom of the crisis, the virtually operating companies were the ones that were best and had the highest sentiment. So companies like Square, digital payment, or Electronic Arts, which is doing gaming. And the ride-sharing companies, Uber and Lyft, were thrown out of the fund because there was a lot of negative sentiment because everything was shut down, and for sure no one needs a ride. In April, it was more like the work from home names. We all know Zoom. Teladoc is a digital medical service where you can give people a call and they say if you are ill or not. So stuff like that. On the negative side, very interesting, Tesla was thrown out of the fund, which was actually for more than a year the #1 sentiment name in the fund. So very, very positive, everyone. Now it turned kind of like out of favor. And in May, so the last rebalancing we had, stuff like streaming, e-commerce was very positive. And Zoom was again kicked out because there were security issues, we all know, and people lost their confidence there. So does the AI pick up the right trends is kind of like the second thesis, right trends in the winner stocks. And I just wanted to read out some of the comments people were posting on StockTwits. And now I would like to take Zoom as an example. So on top, you see simply the performance chart versus the S&P 500. And then on the bottom, it's again the outperformance per rebalancing. If the line is green, the position was in the fund. Else, when it's red, it's not in the fund. And you see here, shorts will get burned tomorrow. Boss says conviction trade. Buy, so very positive. Or people looking at if short-term obligations is fine. If the CEO is selling his shares, if there are security issues, so stuff like that you see there. And I just heard my time is up, so I have to skip the next slides, but I hope you will see them later, probably, so you can look at them again. So just that as a last one. We have 9 months straight AI outperformance versus the S&P, which is our benchmark. And it's not only working in bad times, it's also working in good times. So I think that's something very good. And AI is unemotional for sure because we have a monthly rebalancing. So it's just doing its job like we told it to do. These are the fund data, sales team, our contact details, and for sure everything that I've said could be wrong, the disclaimer. So thank you for listening and happy to take your questions.
Kevin, thank you very much. I know you are the AI global equities strategy extremely well, and correct me if I'm wrong, performance during the big drawdown period was not very good, negative over 30%, correct? Somewhere in there. But in all fairness, I mean, performance is one thing, but I know, and from our discussions, value of an AI-powered fund compared to a similar strategy that is non-AI powered is the diversification in terms of the names in the portfolio. And that is extremely important. Now, I'm not sure if you compared at that time your names versus the non-AI peers, but for any investor, even if you're down forever, it's extremely valuable if they're holding 2 similar funds at the same time to sort of be aware of that, correct?
Yeah, that's totally correct. So as I named it, when I was in January at the Fall Congress in Mannheim, I had a lot of talks about the AI global strategies, and a lot of investors were telling me that I listen now at that day to 10 global managers, and everyone has the same names in his in their top 10, you know. And so they always say it's really refreshing hearing from you every year what your new top 10 names are, and so it's really. The AI is very unemotional with that, you know. So it's not saying, "Oh, everyone has Amazon in his portfolio, so I also have to take it," you know. It's really just doing its job, and for investors, it's really a kind of like strategy diversification effect, as you said. I mean, I don't know, I don't need 2 very identical global managers having the same top 10 names. In the end, people want to have diversification, and you don't get it by having exactly the two same funds. Yeah.
Yeah. With regards to the ACATIS Buzz Fund, I have noticed that, and I've seen this fund over many years, I've noticed that this fund during this period is significantly outperforming, and today may be one of the best performing AI-powered funds in the universe, according to our research. Why do you think during this period a sentiment-based approach is having such a positive impact?
Yeah. So for me, first of all, I mean, looking at other sentiment strategies, it's really a completely new way of measuring sentiment. Because, you know, there are typical measures like doing surveys and stuff like that, but you know that everything takes time. So you get maybe the survey results a month later, when you should already have had to act in a way. And the way we do it, like really measuring real time the sentiment of all these stocks, is more like a nowcast than like a forecast into the future. It's really at the pulse of all this data. And I think what is also very important to mention here is that we don't do or Periscope is not doing a connect to the market. It's not like trying to predict the next 6-month performance. It's really just analyzing this text data, and then aggregating this. And the hope is that this sentiment, this really fast sentiment of the companies, helps to find the winners in the market. And even though I could not show all the examples now, but for sure it's not 100% right at all at all time. But a lot of these picks were really good at that time, and it found really the right stocks at the right time. Yeah.
Yeah. Possibly. I mean, my opinion would be during this time that, and I'd like to hear from Periscope, possibly this time that there is just more talk. People have more time to talk. They're sitting at home, more sort of chatting to each other. They're reading the news. I mean, I could see it all over, including my family. There's much more passing back.
Yeah.
There's much more chatter going on.
Yeah.
So I think the frequency of this sort of type of, you know, whether it's on Twitter or, you know, or any other social media or wherever, in the paper, there's just so much information now, and there's so much conversation, and that might be, you know, an advantage for something that is, you know, sentiment-based.
Sure. I mean, more data in this case is always better. As more people doing stuff online, it's very positive for the strategy, because also our investment universe is growing. I mean, currently Periscope is looking at 300 to 350 names in the US, where is enough conversation online. And if people are doing more online, for sure, it's great for us, having a greater universe of stocks to pick out of.
Yeah. I think one of the things, you know, what Hendrik was mentioning before about, you know, what improvements and what things and so forth. I think sentiment, which is not expensive, and natural language processing is all over the place. I think if people started to incorporate sentiment into their core AI approach, that could add some value in terms of names and alpha generation. Yeah.
Absolutely. And also, I mean, if you see now our two funds, they are very contrary. You know, you have on the one hand side, very low frequent fundamental strategy. On the other hand side, you have the sentiment, more high frequent strategy. So combining this is for sure something which is on our to-do list. What is still very hard to do is to do it in a different language. So it's not easy simply taking your strategy that you have in English, so to say, and then put it to Chinese or German or Italy. That's still a way to go to have a global strategy with all of that.
Yeah, I mean, just on that note, just from my experience, I think people talk mainly about stocks that are regional. So if, you know, to ask people in China to talk about a U.S. stock is whatever. Kevin, we're up. Thank you very much.
Thanks, too.
Enjoy your weekend.
Thanks.
See you next time.
Yeah, bye.